Hey everyone, welcome back to Corporate Decoder, the place where we translate corporate jargon into something you can actually understand. Today we're diving into nVent Electric's latest quarterly report, and let me tell you, it's got a plot twist worthy of a superhero movie, or maybe just a slightly above average electrical connection company. We are looking at nVent's financial health segment performance and a major sale that's juiced up their cash reserves. Before we get started, if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below where you can discuss all things corporate finance. Alright, let's get down to business. This report covers the first 3 months of 2025, ending in March. So what happened with nVent in the first quarter? First up, the top line. Net sales, or the total revenue from selling stuff, hit $809 and 3 million toots. That's a noticeable jump from the $732 million TAV they see of time last year. That's about a 10.5% increase, not bad at all. But here's where it gets interesting. Check out this line. Income from discontinued operations net of tax. This is where most of the excitement comes from this quarter. It shows a whopping $273.7 million last year. What's going on? Well, it's all about the sale of their thermal management business. This sale gave them a huge one-time boost. They sold it for a cool $1.7 billion. This sale significantly impacts their earnings this quarter. Because of this sale, their basic earnings per share jumped from $0.64 to $2.18. Without it, the earnings per share would only be $0.53, almost 4 times less. That means the sale has seriously skewed their financial results for the quarter. It gives investors a large one-time gain, but it's important to remember that this type of gain will most likely not repeat itself next quarter. Looking at the balance sheet, the amount of cash and cash equivalents is now $1,343 in a million. That's a huge increase from the $13 in one bottom 23. So what they do with all this cash is something we will need to keep an eye on. On the other side of the balance sheet, we can see they are still carrying a heavy load of debt. Their long-term debt is still at $1,748 million. It was at the end of last year. This suggests they didn't put most of the incoming cash to lowering their debt. The net cash provided by investing activities of discontinued operations shows $1,383 and 1 million, confirming the cash injection from the thermal management sale. It is slightly less than the initial price, since transaction costs had to be taken out. Also worth noting, goodwill is still a big number, sitting at $2,228 million. Goodwill is what happens when a company buys another company for more than its tangible assets. It's an intangible asset that represents things like brand recognition and customer relationships. A large goodwill raises the question of whether they overpaid for previous acquisitions. Now let's scroll down to the statement of changes in equity. It seems small, but it's worth mentioning. Shares surrendered by employees to pay taxes cost the company $8.3 million. This just means that employees use their stock options to pay their taxes. Now we get to the interesting part where we are able to see the numbers behind their net sales. Most of their sales comes from the Americas, fixing $63.9 million. The next largest region for them is Europe, Middle East, and Africa, with sales of $136.7 million. What we are looking for here is any major shift that might indicate changing market position for them. Breaking it down by the vertical that they operate in, we can see the industrial sector generates the most sales, that showing $264.4 million, followed by infrastructure, temp serve, $13.4 million. Looking at trends could show opportunities for them to grow in certain specific industries. Now let's talk about restructuring. These are costs associated with reorganizing the business, like severance payments or closing facilities. Restructuring related costs included in selling, general, and administrative was $0.9 million. These costs can signal changes in the company's strategy, for example, focusing on a specific region. We mentioned this earlier, but it's worth noting more explicitly. Earnings per share is an important metric for investors. Basic earnings per share is $2.18 and diluted earnings per share is $2.16. This is inflated by the sale we mentioned previously, and without that boost, these numbers would be much lower. Moving on, there's information on nVent's acquisition of Tractor. It shows how they've allocated the purchase price to different assets and liabilities. This gives a clearer picture of what they actually acquired and for how much. For example, the identifiable intangible assets were valued at $315 million, and their goodwill was $368.5 million. And their goodwill was $368.5 million. And their goodwill was $368.5 million. This is an unaudited view into what the combined companies of nVent and Tractor would have looked like had they already been operating as one previously. This helps investors understand the long-term investment. Their revenue would have been $789, $9 million. We already talked about it, but let's show the full operating results of discontinued operations. They report sales of $40.5 million before the sale and a massive $273.7 million boost after taxes from the sale. This table is a geographical view on the company's goodwill, most of which is allocated at $1,431. Ever a 7 is useful for investors to track the value of acquired assets over time. Identifiable intangible assets are things like patents, trademarks, and customer relationships, and those are sitting at $1,557 as sitting at million. This provides an idea of what makes the company different than its competitors and what value it carries other than from tangible stuff. Here we can see that the total debt the company owes sits at $1,773.8 million rate debt, making them prone to interest rate fluctuations. The company's debt-weighted average interest rate is at 5.672% on the 2024 term loan facility. The fair value of financial instruments measured with recurring swaps are measured using level 1 and level 2 assets, as defined by standard accounting procedures. This is an approach to show the actual market value of debt, swaps, and options that might be on their books. Finally, this shows how the company's debt is broken down in time, with most debt maturing in 2026, touching $218.8 million, and 2028, $721.3 million, implying the company will need to make sure that its operations are profitable so they can repay it. And now for my thoughts. Overall, nVent is going through a transition. The sale of the thermal management business has given them a huge pile of cash, but it also means they've lost a significant piece of their revenue stream. The electrical products group acquisition can help them offset the loss of business from thermal management. Their debt is a major challenge. While they have a ton of cash right now, thanks to the sale, they're still carrying over $1.7 billion in debt. Managing that debt, especially with variable interest rates in play, will be crucial. I am watching their strategy. It seems to me that they are going for growth in specific sectors. Their strategy has pros and cons. They are in position to win big, but if their chosen sector stumbles, they will also be impacted heavily. So, in conclusion, nVent is at a crossroads. The cash from the thermal management sale gives them options, but they need to use that cash wisely to reduce debt, invest in growth, and navigate the challenges ahead. It will be interesting to see what their next strategic step will be. Alright, that's our breakdown of nVent Electric's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. And again, don't forget to check out the Discord in the description. Thanks for watching. See you next time.